Good morning, everyone. Welcome to the Main Management Weekly Market Note podcast. I'm James Maxwell, VP of Research.
And I'm Alex Dippery, Research Analyst here at Main.
So, just starting out, we want to give a quick plug to our 4 ETFs as well as the custom model partnership that we do here at Main. We have for 20 years built portfolios using ETFs, and we offer this as a service to advisors, helping them build better and stronger portfolios for their clients. So if you're interested, please reach out. Starting with the kind of broad market performance and sector performance, had a pretty interesting week last week, especially under the covers. The S&P, you just looked at that, it was flat, but there were a couple of days there that the more risk-on stuff got hit pretty hard. Had a bit of a recovery on Friday, but overall, pretty rough couple of weeks for especially the more speculative, more risk-on names. Alex, and anything to add to that?
Yeah, and in addition, to more broadly the risk off sentiment, there was definitely something around the margins of higher inflation being priced in. You saw healthcare doing well, energy doing well. We haven't necessarily seen that in the data yet, but it is consistent with sort of what we were hearing from FOMC members. So just something to watch around the margins.
Yeah, and we'll get into kind of what the FOMC, what their kind of views are on inflation recently here in the next couple of slides. But before that, just quickly on the recession dashboard, kind of remains as is, pretty neutral with slightly tilted towards positive or green. But that's remained the same for a couple of months now. On the government shutdown, that's one of the big headlines as well, finally resolving itself, the longest government shutdown ever. One thing that we'll take away from this is that the market really did not care that much about the shutdown, especially with regards to broad market performance. The most important thing was the earnings season that was going on, and that was a very good earnings season, which we'll also get into, and that was what drove most of market performance rather than the kind of politics or broader government shutdown.
Yeah, it will be good to see for the FOMC, even though October data won't be published, a resumption of data after that.
Yeah, there is some final. You've heard many different things. I think they're planning to release the September employment data, so it's already a month plus delayed here on Thursday. I've heard a couple different things on the October data. I've heard some people say we won't get it at all. Like they didn't survey the labor market or CPI data during those periods because the government was shut down. So there's a chance that none of it might come out. You've heard, I think Kevin Hassett from the White House said that only the payrolls side of the employment report would come out, but not the household side, meaning we won't get the unemployment rate, which is kind of like a weird quirk.
Yeah.
But I'm sure they're going to figure out all of that stuff. There's a chance we will be missing monthly data points for October for a few different reports, but it is what it is. The time has passed. One big thing that happened last week, this was kind of following the previous week with the FOMC talking about less of a chance of a December rate cut. You heard Powell say in his presser that it was not a kind of foregone conclusion, was the phrase that he used. And you really saw markets kind of focus in on that this past week. Several FOMC members came out and talked about the risks to inflation, how they were more worried about inflation, less so on labor markets, kind of reversing course a little bit, especially people that kind of previously were dovish, turning more hawkish. I think that commentary caught people a little off guard. A lot of people thought that December was kind of a locked-in cut, but that commentary proved otherwise. It kind of ties back in with what you were saying, which is there is kind of this concern on maybe the inflation side of things. I don't know if we see that, but anything to add there from your side?
Yeah, I mean, I think this repricing of probabilities was especially pronounced on Thursday.
Yep.
You look sort of from a size and style perspective of what sold off in the S&P. The big loser that day was small cap growth.
Yep.
And so very consistent with what you'd expect from higher rate expectations. Yeah, I mean, for now on the inflation side, we're sort of in wait and see mode.
Yep.
If the data comes out and supports that, then that'll be our view. But until then, we haven't seen anything yet in the near term.
There's also kind of this interesting dynamic where a lot of the big players that have sold off have been kind of adjacent to the AI energy trade, kind of nuclear names,
Yeah.
very, very speculative things that don't have, any sort of profits or even revenues today and are building out for 10 years in the future. A lot of those have gotten, hit pretty hard, down 20, 30, 40% from their peaks. I think that ties in, it's hard to distinguish the two, but it ties in with this broader kind of hawkishness from the Fed. Certainly, a more hawkish Fed is not kind of accommodative to these very long duration risk assets. But also, I think there's kind of the confounding there where you had this speculation, you had a lot of frothiness. I think everyone
Yeah.
kind of saw that in like crypto and in these nuclear names, in these like very,
Right.
very speculative, 100 times price to sales type of names. You saw some pullback there for sure, some correction there for sure, coming off of just a very, very kind of speculative peak, a mini bubble almost.
Yep.
So it's actually probably healthier to see that some of that pulling back in, some of that speculation pulling back in.
Right.
Whether or not that was directly caused by the FOMC or not, kind of hard to say. Moving on to some of the economic data we did get, we got this NFIB Small Business Optimism Survey. It's continued to kind of remain around its median. It decreased in October. One big thing that we did take away from that, they asked kind of what the most important problem is to these small businesses. And the proportion that answered quality of labor spiked up pretty considerably. You can see on that right side there is now at 27% of responses as their single most important problem. And I think this ties in broadly with kind of the labor market that we've been discussing. Weakness kind of, marginally across the board, not outright spike in unemployment or anything like that, but just kind of marginal weakness, especially as you were saying, kind of in the maybe new grad, lower age cohort.
Yeah.
Right.
There's definitely been some friction at sort of that area of new entrance to the labor markets. This quality of labor issue also is something that we've seen a little more anecdotally, people be talking about
Yep.
having issue with new college grads and especially as it regards to professionalism
Yep.
and other issues. So it'll be an interesting thing to continue to watch, especially as we see the U rate for that youngest cohort taking up considerably.
Mm-hmm. Looking more specifically at the sales and employment surveys that were asked in this NFIB, sales kind of continuing to be somewhat soft in that area. Employment as well, continuing to be somewhat soft, kind of telling you overall the unemployment side, or sorry, the employment side, stacking up with that quality of labor. Like it makes sense that they would see employment as kind of soft and also looking soft going forward. One huge thing that has kind of dominated the at least market return this past few weeks to a month has been earnings season. It's been a very, very good earnings season relative to expectations. This is a chart here that looks at the annual earnings per share estimates for 2023, 2024, 2025, 2026. And that red line is the forward consensus estimate, so just forward 12 months, so kind of looking through time. And you can see that 2026 and 2025 really hooked up just the past kind of couple of weeks. That's rare to see earnings hooking up,
Yeah.
especially for the current year, so 2025. Like it's rare to actually have an improvement from like a lower base. Usually what happens just over the broad trend, unless you're coming out of a recession, usually what happens is you start really high on earnings expectations, expectations are high and then they kind of gradually come into reality. It's good to see that earnings expectations are actually increasing, or I should say actuals are actually increasing. And then 2026 is accelerating as well.
Yeah, especially amidst all this talk of a potential bubble.
Yep.
Seeing earnings patterns like this is a sign of a very healthy bull market.
Yep.
We've already blown past where we a couple months ago thought we would be at for the forward 12-month number at this time by the end of the year.
Mhm.
So to see not only, strong earnings growth, but considerable beats on
Yeah.
what we were expecting is really encouraging.
Yeah, speaking of the beats here, This is a couple different ways of looking at kind of how things came in relative to expectations. The left-hand chart looks at each of the quarterly earnings, kind of year-over-year growth, and then what those look like over time, those expectations. You can see that green line, the growth came into the quarter, I think around 6.5%, 7%, is now at around 14%, so much better than expected. Similar on the right-hand chart, similar story, different data, but overall similar story where those blue bars are kind of the latest estimates or actual kind of data based on what the quarter is. The green dots are what the expectation was at the beginning, or sorry, at the end of the quarter. So kind of before earnings season or before the companies actually reported. You can see that every quarter so far, year to date, and even since 2024, has come in above expectations. And I think that speaks to a lot of why the market's been running so well for the most part, is because earnings have been continued to do well.
Yep.
Moving on to some other kind of weekly data that we've got, the MBA mortgage data, mortgage rates ticked up slightly higher. You can see they're in a broader downtrend, but certainly ticking up week to week here has not helped. The applications, the number of people actually applying for mortgages, it's kind of stayed stable here. You saw it shoot up and then come back down, but overall kind of remained stable, at least for the past few weeks. That ties in nicely to the refinancing index. So that's the number of people trying to refinance their mortgages. That's actually done considerably better than the applications. I think a lot of that has to do with refinancing is on your existing mortgage is an easier thing to do rather than applying for a brand new mortgage.
Right.
Moving, you kind of require it requires a buyer and a seller. This market's been very frozen where people don't really want to sell their homes because that would require moving into a new home. So there's all that kind of dynamics there versus refinancing is more of a pure like what mortgage rates are relative to what someone's existing mortgage rate is. And you can see that on the purchase index is kind of relatively low and has not moved up considerably. And that's all for this week. Just as a summary here, government shutdown finally over. Markets seem to not really care about it that much, considering it was up 2.4% during the shutdown. Small business optimism continuing to be kind of moderately weak. Interesting to look under the covers there, seeing their focus on the employment and weakness of the labor market. Earnings season continues to be very strong. Q3 wrapping up here soon, but looking like it's going to be a very, very strong quarter overall for the broad kind of U.S. equity market. And finally, the mortgage rates kind of continuing to trend downwards. You had to tick up last week, and you see those reactions in those different applications, purchases, refinancing, etc. With the government reopened, there's going to be some mix of data coming out. There's not. I know that some of it's still kind of being in the works of what's available to be released and what's not. The expectation is that industrial production is going to be released on Tuesday, housing starts and building permits on Wednesday, unemployment claims Thursday, flash PMIs in Michigan, consumer sentiment on Friday. But we will see exactly what data gets released and when, I'm sure, as over the coming couple of weeks.
Something else to watch out for just as a catalyst is NVIDIA earnings this Wednesday. Obviously a huge driver of equity markets and people's confidence in AI and earnings growth overall.
Yep.
So another thing to watch out for there.
Yep. All right. That's all for this week. Thanks all for joining us.